Our strategy seeks to capitalize on valuation dislocations due to temporary pressures and negative sentiment. And the current backdrop should provide some pretty exciting opportunities for us.
This is 401k Specialist Editor-in-Chief Brian Anderson, and this is the 401k Specialist Podcast. Today, we're going to check in on large cap value investing and its place in a 401k investment lineup. Specifically, we're going to look at the current economic and market environment, inflation, and how it all presents a unique opportunity for the sector, which is often included as an investment option for 401k plan participants, as its emphasis on large cap value stocks aligns with the long-term investment horizons typically popular in retirement plans. We're going to dive into it right after this brief message.
Heightened market volatility has refocused attention on large cap value strategies in participant equity allocations. When looking at large cap value investing, there are 3 key points for plan sponsors to consider. Explore how an active large value strategy can help enhance your DC plan. To learn more, visit invesco.com/DC advisor.
To provide a rundown on the state of large cap value investing, we're happy to have Invesco's Devin Armstrong as our guest today. Devin is the Senior Portfolio Manager, co-lead for the Large Cap Deep Value Strategy, and Director of U.S. Value Research. As the co-lead portfolio manager of the Invesco Comstock Fund, Armstrong helps retirement plan advisors understand why they need to be looking at including value equities in a DC plan investment menu, and how value can help 401k participants be properly diversified with their plan investments. Welcome to the 401k Specialist Podcast, Devin.
Hi, Brian. Thanks for having me. It's great to be here.
All right. Well, now when it comes to 401k plans specifically, what is the value proposition behind the case for including large cap value within the investment menu of a 401k plan? What can it do, or what's its role for the typical retirement plan participant?
Sure. 401k plans play a really important role in building wealth for retirement. On average, I'd say these plans typically are longer term in nature, with the investment goal of really generating the highest return possible while being consistent with the investor risk tolerance. Building and maintaining a portfolio that's really diversified across asset classes and styles, it's critical because it really allows the portfolio to optimize the risk return characteristics over time. Large cap value category overall, I think, plays a really important role in that effort because it contributes to the overall diversification of the plan. If you look back over history, the relative performance of kind of growth versus value equities it's really oscillated over time. And so given the combination of the long-term nature of these 401k plans and the long-term shifts between growth and value, I think it's important to keep a few things in mind. One kind of is the style rotations between growth and value are really difficult to predict. So investors need to have a balanced exposure to really avoid being incorrectly positioned when these things occur. Second is really, the backdrop for value investing overall may really be improving. Growth has really meaningfully outperformed value since the global financial crisis, as the low interest rate environment during that period really created an ideal environment for growth investing. If you fast forward to today, we're kind of in an environment where inflation and rate expectations have increased to levels that are more consistent with history. And that backdrop really could be more favorable for value. If you look back over history since 1975, when inflation's above 2.5%, value has actually outperformed growth. And then lastly, I just say a kind of a recent case study. If you want to look at 2022 as a reason why it's important to keep a balanced portfolio, that was obviously a very challenging environment for U.S. equities with the S&P 500 declining close to 20%. However, having exposure to value during that period improved the performance versus being only exposed to growth equities.
All right, great. Now, I know that your large cap fund offers diversification across various sectors, including financial services, healthcare, technology. But can you give us a little bit deeper overview of the Invesco Comstock Fund investment strategy?
Sure. Yeah, the Invesco Comstock Fund is really unique within the industry given its history. The fund actually started in the 1960s and has operated as a value strategy for the past roughly 30 years. Now, overall, the strategy leads with valuation and it is 100% bottoms up. So what that means is we're not guided by any overarching global views or any thematic direction. Instead, we really focus on the underlying valuation of individual securities to drive our portfolio positioning and kind of areas of focus. As far as philosophy, we are intrinsic value investors, and I define intrinsic value as kind of a conservative estimate of the company's value based on its sustainable levels of cash flows and returns. And so when we're looking at companies, we're not focused on what we think it can earn at the top of an economic cycle or we think it can earn at the bottom, but really that more sustainable level based on our knowledge of the business. And then we wait for the market to give us an opportunity to buy those companies at a discount to those values. And so we really follow that process over and over again, and it results in a portfolio which really we believe has very attractive risk return characteristics. The fund has a strong track record relative to our index and peers. And when I take a step back and think about the elements of our philosophy and strategy that have really contributed to our success over time, I'd say a few things stick out. First, I'd say we have a very experienced management team with a long-term track record of navigating various financial market cycles. The team's ability to draw on experiences managing through the dot-com bubble, the global financial crisis, COVID, all provide valuable perspectives. I'd also add that the strategy's approach is really highly contrarian. In general, we don't believe stocks trade at a discount to intrinsic value without some type of reason. And so we lead with valuation in order to help us identify companies that are really facing some type of near-term challenge, which we expect over time to reverse. And then lastly, but certainly not least, is I'd say we are extremely patient investors. Our typical holding period is 5 to 7 years. And what that provides is kind of a unique lens for us to view investment opportunities as we look out across the market.
Great. All right. Well, in our prep call, you mentioned that there are a number of different flavors of value in the industry. Can you tell us what you mean by that and discuss how your team approaches these flavors? Essentially, I'm kind of looking at how the Comstock team identifies value stocks and what's your screening process and strategy.
Yeah, the definition of value varies significantly across the industry. So even if you look at value benchmarks, there's not really a single definition, as some indices lean more heavily on price to book or others more so on price to earnings. Now, these differences in construction have really significant implications when you think about the holdings and returns of those indices. So, and the reason why that's important is decades ago, most company investments were primarily in tangible assets, things like equipment and plants. Fast forward today, and most of those investments are kind of the intangible kind, which are not really fully reflected in book value. So you can see the challenge depending on how you're defining value being impacted by that trend. The Comstock strategy does not have a single metric or definition of value when looking for new ideas. Instead, we kind of use different valuation metrics depending on the type of business we're analyzing. So this generally equates to when analyzing more cyclical or capital-intensive businesses, we're leaning heavily on things like price to book and enterprise value invested capital. However, when we're analyzing more stable businesses, we're going to lean more towards earnings and cash flow-based metrics, things like price to earnings, EV/EBITDA, and free cash flow yield. So this more flexible definition of value really allows us to capture a broader set of opportunities in the market. And over time, this is equated to a fund that's really been overweight and underweight every sector of the market. However, I think it's important to highlight that we do not buy securities based on screens. Now, our screens are really helpful for us to get to our end goal of identifying securities that are facing some type of headwind that we think will reverse over time. So really, after identifying the securities that are, quote, quantitatively expensive, we then conduct really the fundamental analysis to determine whether or not it fits well within the fund. And this is how we spend the vast majority of our time. And this is really digging into everything to understanding the businesses, the competitive dynamics, the management teams, every piece of information that we would need to have in order to build up conviction and to understand whether or not the headwind we're seeing that's driving the valuation disconnect is permanent or temporary. If we believe it's permanent, no, it's probably a value stock and we're not going to spend a lot of time there. We're going to move on. If we believe it's more temporary in nature, that's really interesting to us. And that's where we really dig in to understand, what needs to happen or change for those headwinds to reverse, and then what that eventually means to the fundamentals and valuation of the company.
Interesting. Okay. Now I'm curious about how the portfolio has evolved in recent years. What's changed and what's behind the changes?
The market environment has really changed over the last decade, and the fund has adjusted accordingly. We've had a number of shocks and interest rate changes that have really resulted in a significant shift in portfolio positioning. Kind of entering 2020, if you take a step back, the fund was really overweight areas like energy and financials because we view those areas of the market as offering really the most attractive risk and returns. However, when COVID hit, it was so disruptive to every sector of the market that it really significantly expanded our opportunity set for finding ideas. So you think of areas like travel where no one was traveling, or you think of dental where no one wanted to go to the dentist, and hospitals that were completely disrupted. We added significantly to those areas because they really fell into the wheelhouse of our investment process. The valuation of those businesses had compressed due to a headwind that we believed that was going to reverse over time. Now, we didn't know when COVID was going to end, but we did have a view that it was not going to be the new normal. And so we were able to look through that, leveraging our kind of long-term time horizon. In response to COVID, the U.S. lowered the Fed funds rate to effectively zero and pursued stimulative policies that ultimately sparked inflation. The Fed then responded pretty aggressively by raising rates, and those actions eventually proved effective as inflation has moderated to levels kind of what has been more consistent with history when we look at it today. So from a portfolio positioning perspective, investor concerns at that point related to whether the Fed was going to be able to tame inflation and what those actions were going to do to the underlying fundamentals of businesses created another level of opportunities for our strategy. So areas we were adding to were like communication services, given the opportunity for improvements in digital advertising. Consumer staples had opportunities, given the opportunity for margin expansion as those inflationary pressures eventually ease over time. And utilities, given some portfolio transformation and deconsolidation activity that we believe have the ability to create significant shareholder value. And so if you think about the shifts in the fund, kind of taking a step back, if you went back to 2020, our overweights were largely in energy and financials. If you look at the fund today, we have overweights in areas like communication services, consumer staples, and healthcare. So kind of an example of how we rotate the portfolio to the opportunity set that the market provides.
All makes a lot of sense. Let's talk about some of the current sectors where you're seeing opportunity for value equities right now. Anything raising eyebrows?
Yeah, there's always opportunities popping up in the market. Our strategy is to constantly rotate the portfolio kind of to the areas of the market which we believe are the most attractive risk returns. So, if you look at the market over the past several years, the performance has really been driven by technology and communication services, right? These are businesses that tend to be very high quality. They have very attractive growth profiles. They have strong balance sheets and typically generate significant free cash flow. So they're really exactly the type of businesses investors want to own. You then add the potential opportunities from AI, which added further excitement to the group, and it really resulted in these sectors significantly outperforming the broader market. Now we're like everyone else. We like these businesses as well, but we've been reducing our positions in these areas given the risk and return trade-offs and characteristics of those names that we owned becoming less attractive given their market appreciation. So on the flip side, a couple sectors where we are finding opportunities more recently have kind of been in the healthcare and the consumer staples space. You would think about our strategy and our contrarian nature. It's not surprised that we'd be migrating to areas of the market which have really underperformed in recent years. And while these areas don't have the same growth profiles of technology and communication services, we're focused on finding businesses that are trading discounts to intrinsic value, and healthcare and consumer staples has been ripe for those types of ideas in the recent environment. So within healthcare, one of the areas we're seeing attractive opportunities is really within the managed care space. The valuation of those names have compressed in recent years due to the regulatory concerns and more recently margin compression in the Medicare Advantage market. That's a business that typically generates kind of low to mid single digit margins, but profitability has really been well below that lately due to higher than expected medical cost trends and really a period of management's being overly focused on enrollment growth, kind of at the expense of profitability and margins. But the good news for us at this point is, we believe, we're getting into the later innings of that trend, and that we've had a number of recent management changes across the space. I think we've seen a shift in management focus towards profitability and adjusting plans to make sure that the margin profile improves. And we believe add on that a normalization in medical cost trends, and we think there's meaningful margin expansion opportunities for the group. So that's an area that we're finding opportunities. Another is within consumer staples. We're finding some opportunities within the household product space. We recently bought a global leader kind of in the health, hygiene, and nutrition space. That stock had underperformed the market due to several headwinds, including margin pressure, which I kind of alluded to before, you're seeing across a number of areas within consumer staples, but also, elevated leverage from some M&A activity and a high level of management turnover. Again, we think we're getting closer to the other side of those headwinds. We believe many of the challenges are at an inflection point with margins at trough and likely to increase going forward. Balance sheets that have largely been delevered, and once that process is done, that creates the opportunity to increase share repurchase, which is usually a good catalyst for value stocks. And then lastly, we're optimistic about some of the new management team that's been put in place. And so, these are just a couple of areas that we're finding some value opportunities today.
Right. All right. Lots of areas there. Well, before we wrap up, 2025 seems to be off to a pretty volatile start with the markets. Now, how do you anticipate the current political and regulatory environment, especially potential tax policy changes in market volatility? How might that impact the Invesco Comstock Fund's value-oriented investment strategy?
Yeah, I know. I'd say at a high level, I would not expect any changes in the Comstock strategy or investment process. We will continue to lead with valuation and identifying opportunities. We'll continue to be highly contrarian in our nature because we believe that creates the most attractive opportunities. And we will continue to leverage our long-term horizon to drive performance. Now, what I think may change is where we find attractive opportunities in the market. Now, those areas, as we've discussed earlier, have really shifted in recent years. And the current backdrop probably raises the likelihood that it will shift again over the next several years. If you take a step back and look at the market, there are several kind of cross-current themes that could lead to a pretty volatile environment. On one side, potentially lower taxes, which should be a positive for individuals and businesses, potentially lower regulation, which should be a positive for corporate growth and investments, the higher energy production. So just a lot of potential, stimulative benefits that could be flowing into the market. On the other side, tariffs and shifts in the geopolitical landscape are wildcards. They're very difficult to predict how those will play out, and that creates an increased level of uncertainty. So I think it's important to note, though, that each company and each industry is kind of affected differently by these cross currents. If you take the example of kind of a higher energy production being a goal of the U.S., if we get higher energy production, if we're able to achieve that goal, that would be positive for consumers that are buying gas at the tanks, but it could potentially be negative for energy companies if the oil prices decline due to increased supply, if it wasn't offset by an increase in oil demand. So again, very hard to predict how they'll play out. But so far this year, the market has had to digest quite a few headlines that are full of opportunities and risks. However, when we take a step back for our strategy and our long-term orientation, we think these types of environments create interesting opportunities. Our strategy seeks to capitalize on valuation dislocations due to temporary pressures and negative sentiment, and the current backdrop should provide some pretty exciting opportunities for us.
Well, you're right. I think there will definitely be some interesting opportunities. This has been really educational. It certainly sounds like there's lots going on in the large cap value sector. Devin Armstrong from Invesco, thanks for joining us today and sharing all these insights on the 401k Specialist podcast.
Thanks, Brent.